Hello, this is Steve Santangelo of the SRS Rock Report, and today I'm going to do a quick update on the crazy markets. And as we saw during the last hour and a half of trading on the Dow Jones, it fell 400 points from 230 to close. Had something to do with the Fed minutes. In all reality, it doesn't matter. What the Fed says, what the Fed doesn't say, the market, the Dow Jones Index, is severely overinflated. There's too much margin. The indicators are to extreme levels. So the rhetoric coming from the Federal Reserve, the U.S. Treasury, or even Wall Street doesn't matter. The Dow Jones Index has a long way to fall. Now, the interesting thing, on the other hand, we're starting to see a silver market price bottoming, and I'll discuss that in this video. Let's take a look at the first chart is going to be a one-year chart of the Dow Jones Index. Now, in April, the Dow Jones was trading at about 20,400, moved up to a peak, 26,600 at the end of January. We had the nice correction, 3,500 points in a very quick period of time, and then we saw the correction and movement higher. At this point in time, we heard a lot of the analysts from Wall Street suggesting it was a good time to buy the dip. I disagree. I believe this is a good time to sell the rally. Now, anything is possible. We could see the Dow Jones Index move higher. I don't think it will move higher by much. It could surpass the previous high of 26,600, but I don't see it moving up considerably from here. And I'll explain why. Now, if we go back to July, December 2007, there were three different peaks before the markets rolled over. On July 2007, we can see that Dow Jones increased to 13,900. We had the market correction, and then the movement higher to 14,100 points in October. Another correction, and then increase to December 2007 of 13,600. And if we even include that spike, it got close to 13,800. Now, it took 6 months of three different spikes before the market started to roll over. Now, it wasn't until a year later we had the big crash. So on October 2007, the stock market the Dow Jones Index was 14,100, moved up to the 13,600 here, corrected, moved back up to 13,000 here. And then we had the big crash in 2008. Fell 40% to 8,500 in the 1 year period. But it wasn't over yet. We still had a low of 6,500 in the first quarter of 2009. So what we could see here, it took a year and a quarter for the Dow Jones Index to finally hit a low. So if we go back to the present chart, it's only down 7%. And if we consider that the Dow Jones fell more than 50% during the 2007-2009 crash, well, we could plainly see that that level would be about 13,000. So this is not a time to buy the dip. This is times to sell the rally. On the other hand, we're seeing an opposite situation take place in the silver price, as I mentioned in some previous videos. I kind of want to discuss it a little further here. Now, as I mentioned, the commercial net short positions are a gauge to give us where the top or bottom of the silver price might be. The higher the commercial net short positions, they tend to control the price now, not in the future, I'd say, but now they can still control the price. The higher the commercial net short position, the higher the silver price. The lower the net short position, the lower the silver price. So during that last update I did, the price of silver was trading about $16.74. It sold off with the market. And the commercial net short positions were about 30,600. The price continued to sell off, and about right here, the commercials liquidated about another 21,000 contracts to 21,900. Now, what's interesting about that, if we look at the COT report, which shows the commercials, they are on the bottom here. When you see a large number, which is about 115,000 net short positions, this means the price of silver is peaking. When they liquidate and we have a low, that's when we have a low in the silver price. Same thing here. This was a peak in the silver price, low. Now here we are once again. The liquidation of the commercial net short positions, the silver price is now more towards a low. We could see lower net commercial short positions, but what we're seeing is the structure of the COT report is building a good bottom. We're nowhere near a middle or a top. Now that's quite different with the oil price. And as I mentioned several weeks ago, a month ago, when I first started doing the videos, I believe the oil price was going to peak. My first video explained the silver price about right here, which was the middle of January. We had a correction, a movement higher, and then the price fell with the markets. And I knew the oil price was going to fall with the markets because there was a very high commercial net short position. Now, at this point in time, the commercial net short position was 761,400 contracts. As the price of oil continued to sell off, the commercials liquidated another 25,000. And at that point in time of the COT reporting period, there were 736,000 commercial net short positions. But what we have here is an increase from $59 to $61.62. So I can guarantee when the next COT report comes out, the commercials will have increased once again their commercial net short positions. If we look at the COT report and the commercial short positions on oil, we could see they liquidated and they declined. But we're nowhere near the lows. The last lows were about 180,000 in 2016 when the price of oil was $30. We're at 736. So different than silver, the oil price is more to top. The Dow Jones is more to top. The silver price is more to low. Now, what is kind of interesting, silver is a bit different than gold. And we can see that in the short positions, the commercial net short positions. Here is where the low would be for the gold net short positions, which are about 75,000 contracts. Even though they liquidated because the price of gold fell during this period, there's still 194,500 contracts. They're like 120,000 more than their low. So during market corrections, we see the silver price selling off and bottoming quicker than gold. During the correction and movement higher, silver shoots higher because it's bottomed quicker. And I just want to show you that again. So the market structure, the COT market structure for silver is much better than gold. And I believe when the market really starts to crash, we're going to see a huge increase in the price of silver as investors move in to protect wealth. Now, I want to move to the insanity taking place with the U.S. public debt. When you think it can't get any more crazier, it does. Now, I've got two little charts here, and this is a table from treasurydirect.gov, and they increased the debt ceiling back in September 7th, and it jumped from $19.84 trillion to $20.16 trillion in just a day. And this here is the February chart of the public debt. Now, as you can see, the numbers changed a little bit, but they remained about $20.49 trillion. Congress went ahead and agreed to increase the debt ceiling, and then it jumped to $20.66 trillion. That was $150 billion in just one day. Now, if we look at the most current reading, February 20th, U.S. debt now is 20.77. So in just a little more than 5 months, 5.5 months, the U.S. debt has surged by $925 billion. Now that's bad news. that is a much quicker increase in U.S. debt, and it's impacting everything: the deficit, the interest expense. So let me get into first the debt. I posted this chart in a previous article, but it's good to bring it back just to show what's going on. Now, in 2000, U.S. public debt was only 5.6 trillion. It's almost quadrupled. It's now here. When I did this a few weeks ago, it was 20.5. Now it's 20.7. The interesting thing, the interest rate in 2000 was 6.6%. That was the average interest rate the U.S. Treasury paid. And we could see it fell, went to 5%, and then it bottomed in 2016 at 2.2%, and now it's increased. Now, when you've got a huge debt of 20 trillion, you can't have high interest rates. You can't have normal interest rates because the government can't afford it. And I'll show you in the following chart. Normal interest rates of 5% would mean our 20.7 trillion of debt would be over $1 trillion in interest expense. So, and just this 925 billion we've increased in 5.5 months. Once you get to $1 trillion, which won't take long, that's an extra $23 billion we're paying a year in interest expense based on the 2.3% interest rate. So there's a lot that can be done with $23 billion. So we're starting to see an increased exponential movement in the debt, and the interest rate, the interest expense is becoming unbearable. Now, I wanted to get back to the oil production. I've shown this chart in my previous video and in an article, but I wanted to bring it back because I'm receiving comments and I've seen analysis that the peak oil theorists, the people who were analysts who were talking about peak oil and the falling energy return on investment, they're wrong. Well, we're not wrong. Our timing is off. And it's not a matter of decades, it's a matter of years. Now, and I'll explain. It took 23 years, as I mentioned, for U.S. oil production to go from 5 million barrels to 10 million barrels in 1970. It took 23 years. This was conventional. This was high-quality oil, which was over an energy return on investment of 25 and higher to 1. However, we peaked and we had a symmetrical decline in production. Now, shale came on. Now, shale's energy return on investment is about 5 to 1. It's probably less than that. But it's doubled U.S. production in about 7-8 years. Now, what goes up this way comes down this way. And as I said before, this chart resembles a Bitcoin chart, resembles the Dow Jones chart. So we're going to see a huge crash in U.S. oil production. And I'm going to come out with a video on more specifics of what's happening with the shale oil companies, how much debt they're having, how much problems they're having with producing the oil, and they're still losing money. So that will be coming out shortly. Now, this is one of my favorite cartoons by Mike Lukovich. It came out during the 2007-8 crash. And I'll be posting it on my articles from time to time, just as a reminder that the end is not near. And as we can see, this looks like a Wall Street broker. Wall Street tanks again, and he says, optimist that the end is here. Well, I think we've got several years for the market to decline, and it could happen quicker. There's no way of knowing, but it doesn't go down in a straight line. We're going to see a lot of volatility like we saw today, a 400-point crash or tanking in the last hour and a half. So I want to conclude by saying that the Dow Jones Index, the oil price, commodities in general, they are more towards the top. We're going to see the oil price fall. It's going to be very damaging for the U.S. shale oil industry. And as the markets continue to crash, it's going to be deflationary. We're going to see loss of jobs, more bankruptcies, and it's just going to get ugly. As that is taking place, the silver price is bottoming. And so I believe we're going to see, as the market continues to sell off, the silver price will bottom, the precious metal prices will turn around and move higher. It'll be one of the only few places to protect wealth. So I wanted to thank you for watching this video. Please consider subscribing to the SRS Rock Report YouTube channel. And my next update, I am going to discuss what's happening in energy. It's important that you check that out because the energy is the key factor that drives our economy. Thank you very much.